Welcome back to Wealth and Wisdom. Investing isn't just about numbers, charts, or financial statements, it's also about mindset. The way we think and react to market movements can significantly impact our success as investors. In today's video, we're diving into the psychology of investing, how emotions influence our decisions, common psychological traps, and strategies to stay rational in an unpredictable market. Let's get started. At its core, investing is as much a mental game as it is a financial one. Our brains are wired in ways that can sometimes work against us when making investment decisions. Fear, greed, overconfidence, these emotions often lead to poor choices, such as panic selling during downturns or chasing overpriced stocks during market highs. Recognizing these psychological patterns is the first step in overcoming them. Fear and greed are two of the strongest forces in the market. When stocks are rising, greed can take over, leading investors to buy at inflated prices out of fear of missing out. This is known as FOMO, fear of missing out. On the other hand, when the market drops, fear can push investors to sell at the worst possible time, locking in losses instead of riding out the downturn. Successful investors understand these emotions but don't let them dictate their decisions. Instead, they stick to their strategy and focus on long-term growth. Beyond fear and greed, several psychological biases influence investment behavior. Let's go over a few common ones. Loss. Aversion. Studies show that people feel the pain of a loss twice as strongly as the pleasure of a gain. This can lead to holding on to losing investments for too long, hoping they'll recover instead of making rational decisions. Confirmation bias. Investors tend to seek out information that supports their existing beliefs while ignoring data that contradicts them. This can lead to poor decision-making and missed opportunities. Herd mentality. The tendency to follow the crowd can be dangerous in investing. Just because everyone is buying a stock doesn't mean it's a good investment. In fact, it might already be overvalued. So, how can you keep emotions in check and make better investment decisions? Here are a few key strategies. Stick to a plan. Having a well-defined investment strategy helps you stay disciplined, even when the market is volatile. Diversify your portfolio. Spreading investments across different assets reduces the emotional impact of a single stock's performance. Take a long-term perspective. Short-term market movements are unpredictable, but over time, quality investments tend to grow. Focus on long-term trends rather than daily price swings. Limit market noise. Constant news updates can create unnecessary panic. Set specific times to check your investments instead of reacting to every headline. One of the best traits an investor can develop is patience. Warren Buffett, one of the greatest investors of all time, once said, "The stock market is designed to transfer money from the active to the patient. By staying disciplined and resisting the urge to time the market, you increase your chances of long-term success." Investing is not about making quick money. It's about allowing your capital to grow over time through smart, consistent decisions. Understanding the psychology of investing can help you become a more disciplined and successful investor. By managing emotions, recognizing biases, and staying focused on the long term, you can navigate the markets with confidence. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell, so you never miss an update from Wealth and Wisdom. Leave a comment below and let us know, what's the biggest psychological challenge you've faced in investing? We'd love to hear your thoughts. Thanks for watching, and until next time, stay patient, stay disciplined, and keep investing wisely.